Hello and welcome to this edition of our Tech Talk. And today we're going to look at how to use pensions as a tax savings tool. So why are pensions so tax efficient? Well, firstly, on any contributions you receive tax relief at your highest marginal rate of tax. You get tax efficient growth with the investments or the holdings you keep in your pension. You have the availability of a pension commencement lump sum, which is currently 25% of the value of your pension to take at retirement, completely free of tax. It's inheritance tax free, and with the new pension freedom rules that came in April, you now have the ability to pass the pension down to your children, your family members, free of inheritance tax. And now with the introduction of the flexi drawdown, you have the ability to structure your withdrawal of income from your pension to suit your tax position. So plenty of reasons why there's lots of tax benefits for having a pension. So firstly, let's look at how does tax relief work. Well, it works differently if you have different types of schemes. For example, if you get company schemes and you've got personal schemes, they work in a different nature. So for a company scheme, your payments are made before the deduction of income tax and national insurance. And for high earners, if you've lost some or all of your personal allowance, so if you earn over £100,000, then you should consider salary sacrifice. And I'll be bringing you a video just on this topic, so look out for that, and I'll discuss that in more detail in that video. And for personal schemes, you get 20% tax relief added to your contribution at source. So for example, if you put £80 in, it'll be £100 contribution made to your pension. And there can be additional 20% or 25% claimed through via your self-assessment for higher rate taxpayers and additional rate taxpayers. So what can be invested in a pension? Now, contrary to popular belief, pensions are deemed as stocks and shares investments only, and that's just not the case. With a pension is a very flexible form of a savings investment plan. And the type of assets that you can hold in your pension are, well, first of all, deposit savings, investments, commercial property. This is particularly useful if you are a self-employed individual and maybe you own your own business premises, from anything from a factory to office space. I'll be doing a video just on this and discussing the benefits of holding commercial property in your pension. There's individual shareholdings you can invest in your pension. There's guaranteed investments, and there's many more. So now we're just going to take a look at quite a simple calculation for someone who's employed, the difference between making a pension contribution to not making a pension contribution, and how that'll look for your tax and national insurance. As most people believe that making a pension contribution, for example, in this instance, we're going to do 10% of salary. The quick maths would say to take your gross salary and deduct 10%, and that's how much you're actually paying for your pension. It's just not the case, because as I said before, if you're employed or you're self-employed, there's tax relief on your contributions, and for somebody who's employed, that's your pension contribution is taken before the deduction of income tax and national insurance. So I'll run you through this now. So this is an example of someone who's not making a pension contribution with a gross income of 55,000. Okay, there's a few deductions you can take from here. You have your personal allowance at 10,600, which is the amount of money you can earn before tax is paid. So in this instance, with that deduction, it leaves taxable income of 44,400. So based on the current tax threshold, 20% income tax will be payable on the first 31,785, which equates to £6,357. And then there's a 40% income tax for anything over that, which is £5,046. There is an additional rate income tax threshold as well. It's not applicable in this case, so I haven't discussed it. So the total income tax for a person with these earnings will be £11,403, and a deduction of national insurance of £5,632.80, which gives a total tax deduction of £17,035.80, effectively 31% of your gross annual income is going in tax deductions. And this will leave a net monthly income of £3,163.68. So how would that look now if the same individual made a pension contribution? So for easy calculations, what I've used is 10% of salary. So gross income again of 55,000, pension payment at 10% would come out of 5,500. You can then deduct the personal allowance of 10,600. So that would leave a taxable income in this case of 38,900. As I said previously, first £31,785 is taxed at 20%, so £6,357. Anything over that, tax at 40%, which equates to £2,846, giving a total income tax of £9,203. National insurance of £4,972.80. So in total, £14,175.80, giving an effective rate of tax of 26%. And in this case, reducing the net monthly income to £2,943.68. Let's do a little comparison. So in comparison between the two scenarios, without making a pension contribution and with making a pension contribution, as you can see, the tax deduction is approximately £3,000, with a reduction in effective rate of tax by 5%. Now, based on the net income, as you can see, there's very little difference to this individual making a pension contribution. But the big difference is the money available based on this year's contribution at retirement. And as you can see, with the pension contribution, 5,500 plus growth will be available for them when they decide to retire. So this is how pensions are a very good tax saving tool. It doesn't matter what your circumstances are. If you want to find out more, please don't hesitate in getting in touch. And like I said, there's going to be further videos clarifying some of the other points that we've raised in today's video.